Then let's start the lecture now. If you remember, last week we started talking about financial ratios. And today in this class, we're going to finish this chapter. And on Friday, in the first hour, you have the recitation hour and quiz. You should work on the practice questions, because the quiz question will be one of the practice questions. Because of that, I'm not putting the answers of the questions yet on Moodle, because one of them will be a quiz question, so I want you to work on those. But after you take the quiz, I will make the answers online and visible. Other than that, in the second hour of Friday, we will start time value of money finally, which is the real finance chapter. So I'm hoping that you will be here, because if you get lost on the time value of money chapter, then you will be lost in the entire semester. So it's a very important topic. Today, I will start with, if you remember, we said there are 5 types of, we have 5 different types of ratios, financial ratios. There are efficiency ratios, profitability ratios, which will give us an idea about investment decisions. And then we're going to have leverage ratios and liquidity ratios, which will determine the financing decisions. These are the things we haven't talked about yet. Shareholder value part, if you remember, we talked about market value added and economic value added last week. And we also talked about return on capital very briefly. And let's go back to this one table we went over, because I think it's an important one. And then we will continue from here. So in this table, we have the operating income for different companies. We have cost of capitals. We have total capitalization. Do you remember what total capitalization was? What is total capitalization? What is capital?
Long-term debt plus the equity.
Perfect. It is long-term debt, where the sources come from. Long-term debt plus equity was the total capitalization. And then we have economic value added, and economic value added was basically the difference between how much income is generated by the company and how much return should be provided to the investors. So here we have cost of capital times total capitalization. What was cost of capital? What did we call cost of capital?
What the investors expect.
Wonderful, exactly. What investors expect from this company, the minimum rate of return your investors want from your company. Why is it the minimum return? Because your investors say, I'm expecting at least this amount, because equally risky investments I have in my investment pool are providing me at least this amount. This is what I expect. So if I'm expecting 10% from your company, it means an equally risky company should provide me 10%, but instead of putting my money in that other company, I'm putting my money on you. So since this is the minimum acceptable return for your investors, this is your cost of capital, because that's the minimum you should return as the cost of using their sources. Okay? So that part is how much you should provide to your investors. But this is the minimum amount. The more return you generate for them, the better it is for your investors, of course. And it determines how well you're doing, basically. So in this table, we compared Coca-Cola and Google. And if you remember, I said we shouldn't do that, actually. We shouldn't compare Google with Coca-Cola. Why? Because they're in completely different industries. Coca-Cola is a beverage company. Google is a technology company. And because of the nature of their industries, the characters of those companies are different. And we said cost of capitals are different. It is 5% for Coca-Cola, 12% for Google. And do you remember why? Do you remember the reason why cost of capitals were different? Risk, exactly. A technology company is obviously riskier than a beverage company. Because of high risk, investors are expecting high return. So investors are expecting 12% return at minimum from Google. They expect 5% return from Coca-Cola at minimum. Then in EVA, economic value added, we took the difference between operating income and how much return should be provided to the investors. And the difference were very similar for Coca-Cola and Google. And then we linked it to return on capital. Do you remember what return on capital was? It's basically, seriously, it is return on capital. So how much return is provided to investors in return. This is different than cost of capital. Cost of capital is what you expect to get, but return on capital is basically how much income you generate per capitalization. So this is actually not an expected figure anymore. It is a realized figure. How much income is generated per capital. So the ideas are similar. And as you can see, for Coca-Cola, investors were expecting 5% return, but Coca-Cola returned 20%, 15% more than what investors required. For Google, it's 40%. So investors were expecting 12%, but Google provided 18% more than, right? The total is 40, 28. Thank you. 28% more than what investors required from Google. So this is the return on capital part. So if economic value added is negative, or if return on capital is less than the cost of capital, you're going to see, sorry, I should reword it, sorry. Since EVA and return on capital are very related, we can look at the bottom part of the table. And for FedEx, for instance, economic value added is negative. What does it mean? Operating income was less than what FedEx was supposed to return to the capital providers. And if you look at the same picture from return on capital perspective, investors were expecting 6% from FedEx, but FedEx returned only 5% to investors. So the return was not enough to cover the expectations. So they are related. Negative EVA and return capital being less than cost of capital, right? So can you follow this picture? Perfect. Then we said we have two more book rates of return. These are called book rates of return. One is return on assets, the other one is return on equity. Definitions may change. We're going to follow the book's definitions. And about the formula sheet, again, follow the book definitions whenever you're solving questions. So return on asset can be defined as operating income over total assets. So it is, again, return on assets. It's income per asset. Or you can define it as income per start of the year assets. So what I'm trying to say is here, the idea is same. You're looking at income per asset because we are after how much return I'm going to provide to asset holders, debt holders and shareholders together. So numerator is the same for both definitions. The denominator changed. And the only difference is that for this one, where does income information come from? Which statement? Easy. Income comes from income statement. Assets come from balance sheet. Income statement was a flow statement, right? It tells you what happens in a specific period of time. Assets, balance sheet, on the other hand, gives you the cumulative figure, what happened in the company so far, right? Cumulative. So in order to be able to compare the numbers, what I do is, for instance, I'm interested in 2013 numbers, because we didn't finish 2014 yet. So I want to calculate return on assets for 2013. What am I going to do is I'm going to use the operating income information from which year, which income statement? I'm interested in return on capital in 2013. 2000? Exactly. So I can use this number, year-end number, because it tells me what happened in that particular year. But for the assets part, I can use average total assets. In this case, how am I going to calculate average total assets? It's going to be the average of 2 years. So it's going to be total assets in 2013 plus total assets in 2012 over 2. I'm averaging the most recent numbers out. Why am I doing this? Because if, I don't know, maybe there was a huge merger in the same year, in 2013, which would change the numbers drastically. In that case, when you calculate this financial ratio, numbers might mess up. So I'm averaging out any possible outliers, having huge assets or low assets for something other than the normal operation of the company. So I can average those out. I'm smoothing things out. Or it says you can use income in 2013 and you can compare it with the start of year total assets. So if I want to use start of the year total assets, which balance sheet I'm going to look at?
2014.
I'm interested in return on assets in 2013. I'm looking at the income in 2013, and I should compare it to, it says start of the year total asset. Which year it's talking about? Huh? It talks about the start of 2013, exactly. So which balance sheet you're going to look at? End of the year for 2012, right? Because end of 2012 is the beginning of 2013, right? Because in the balance sheet, when you look at 2012 numbers, it's the day you're closing the store, you're closing all your accounts, let's say. Dükkanı kilitliyorsunuz. Ertesi gün oldu 2013. It's a new year. Start of the year is gonna coincide with the end of 2012. Why am I doing this? The same idea. If something ridiculous happened in that particular year, which boost up the assets or lower the assets drastically, I don't want it to affect my financial ratio calculation. Instead, I'm keeping 2012 number constant, and I'm comparing it what happened in the income of 2013. So just to give us a better idea, we are doing that. So this was return on assets. Let's look at how to calculate this. Okay. So for return on assets, I need two things. I need income and I need total assets. So for the income part, the formula wants me to use after-tax operating income. And if you remember, after-tax operating income was this, net income plus after-tax interest. So net income will come from income statement. So I have all those entries. The last one is net earnings, which is net income. So I have this number 1783 as the net income number. That part is easy. The second part, the formula wants me to use after-tax interest. How am I going to calculate after-tax interest?
Interest times 1 minus tax.
Exactly. Interest expenses here, I have the net interest. I think that was the last thing we talked about. Okay, after-tax interest. For after-tax interest, I'm going to take interest. But since I'm interested in after-tax value, so part of the interest will be paid to the government. I don't care about that part. I care about what I have after tax is paid. So I need to multiply it with 1 minus t. Interest information is already on in the income statement. It says 287. But I don't know the tax rate. So the question is, how am I going to calculate the tax rate?
Tax paid or taxable income?
Exactly. So tax rate is basically how much tax you pay compared to your taxable income. So basically it is, how do you calculate tax you pay? You multiply the tax rate with your taxable income, right? You multiply your taxable income with the tax rate you have to calculate tax paid. So here, what do I have? I have pre-tax earnings, taxable income, pre-tax earnings, 2825. Tax paid is here, income tax provision, 1042. So if you calculate the tax rate, it's going to be around 36%. 36.7 maybe. So if you put this number in the equation here, it's going to be 287 times 1 minus 36%. So after tax interest will be 181. Okay. Now question. Why are we using after-tax interest? Why aren't we adding interest? So instead of adding interest back, I'm adding after-tax interest. Why am I doing this? Or before that, let me ask you like a hint-like question. This is return on assets, right? So I'm interested in the return on asset. What is assets? There are two things. Asset is basically debt plus equity. So the return on asset is the same thing with return on debt and return on equity, right? So return to debt holders and return to equity holders. Now let me ask you the question again. For a return on asset, why am I adding after-tax interest back? Not the interest, gross interest. What? You started really strong and then I lost you because you pay tax to the. Thank you. Tax goes to the government. I'm not interested in. I'm trying to find how much income I have to distribute to my investors, right? Operating income. How much income I can return to my investors. But because of the system, let's say, you generate the income, but part of the income goes to here. Part of the income goes to the government. I'm not interested in this. I'm interested in return on assets. I'm interested in how much return I provide to my debt holders and my equity holders. Net income will tell me how much income I can return to my equity holders. Interest will determine how much income I'm returning to my debt holders, right? Interest goes to debt holders. But in the interest payment part, I also have the tax part going to the government, so I'm removing that part. I don't have to do the same thing for this one because this is already the number after tax is paid, right? Tax part is here. I'm paying tax, I find the income, that will be returned to the shareholders. Interest, on the other hand, is here. So from the gross interest, I need to remove how much money I'm going to pay to the government. So that's why I'm calculating after-tax interest and then adding it back to my net income. Did you get lost? I think I explained it very well. Very seriously. It was awesome. But seriously, do you have questions? No? Okay, so that part was clear. Thank you. The second one is I need to calculate average total assets. For the average, I have the numbers for 2009 and 2008. Average is very easy. So I have the total assets numbers. Add them up, divide them by 2. It will give me the average total asset for those 2 years. Or if you're interested in finding the total assets, start of the year total assets, then what am I going to do? Since I'm focused on 2009 numbers, the beginning of 2009 is the end of 2008. So I'm going to use the number from total assets number from 2008. So with those two definitions, return on assets is 6%. So basically, I'm returning 6 cents to my debt holders and equity holders if they put $1 in my company, right? Income per asset. Okay, 6% more return on top of what they put. So that was return on assets. Return on the equity part is easy, very, very easy. This time I'm going to use net income and equity. So return on equity is it's the return to equity holders. That's why I'm only using net income. I don't have interest here. Why? Because I'm interested in how much return I will provide to my equity holders. And interest goes to debt holders. I don't care about that part now. So net income comes from the income statement. It's the income I can return to my shareholders. And I need to divide it by the equity. So basically it will tell me how much income is generated per equity. You can again use average total equity. So total equity is here. Okay. Now here, total shareholders equity. So you can either add them up, divide them by 2, take the average, or you can use the equity at the beginning of the year, which will be the 2008 number. That's it. So according to this calculation, return on equity is around 9%. We don't know whether those numbers are good or bad, right? If I tell you, oh, this company is returning 10%, can you say it's good or bad? Can you? What kind of information do you need? Consulting job interview questions. What else do you need? What kind of information you should ask for?
Interest rate. Inflation.
It's the common answers, right? Huh? You need to know cost of capital first, right? How much investors required. This is how much return you have, yes, but how much investors required from you. That was one thing. Then what else do you need? You need, somebody say comparison, right? Did someone say comparison? Okay, how can you make comparison? Or what are you going to compare it to? Yes?
The previous year.
Previous year, wonderful. You might ask for the historical trend, one thing. What else? Huh? Yes, yes. Competitors, exactly. Yes, rivals, competitors, peer firms. You can ask for the industry numbers overall, how well the industry was doing. You can ask how well the market was doing. So these are the first things you should ask. Then of course you can go into like expectations and stuff, but this is not a job interview class, so I'm not going to go into that. Okay, so these are the things we should be careful about. One question. Okay, we're still in the interview. I'm asking you how my company can improve return on equity. Start with the basic, please. How can I increase return on equity? Yes?
Make less investments
Make less investments.
to keep your equity.
Why are you making less investments?
Spend less money on different, how can I explain that?
Okay. But actually okay. But if you're making good investments, I'm trying to make sense of it in my mind. I mean, I'm sure it makes a lot of sense in your mind. I'm trying to understand what you're saying. So if you're making good investments, then it will be good. Your income will increase.
If you want to keep them, you don't want to risk that, you can keep.
You can keep the investment level as given. Okay, I think what he's trying to say, if you have bad investments, you can get rid of those bad investments. In that case, return will increase because you're making better investments or getting rid of the bad ones.
not bad ones, but the risky ones I try to explain.
Risky, but this is return on equity. Shareholders are kind of
But
okay
if
with
you want
risk.
to, if you expect a guaranteed return, you can cut the risky investments.
Okay, okay, okay. It might be the case, sure. Okay, but I ask you start with basics. Yes.
Increase the price of the product.
So basically, what are you are trying to increase the net income?
Yes, and
Okay,
by the
so okay, the basics is you should say,
Increase
Hocam,
value.
huh?
Increase value.
That's the answer to everything. Increase shareholder value. But this is exactly what we're trying to do. Yes, this is return on equity. You're right. We're trying to increase value. So basically, in this equation, you can increase net income, right? Like that's why I said start with the basic. So if you want to improve this number mathematically, I have the math background, so I start everything with math. So you increase net income, or you decrease equity, right? So then you can go into more detailed things. You said increase price of the product. In that case, maybe the quantity you sell will decrease. So you don't know whether it will be good. But with different like advertising, you can do more advertising to increase sales. Or what else you can do? You can try to increase sales, or you can decrease the cost. You can be more efficient.
Tax
Probably tax rate is determined, so you cannot influence tax directly. But you can, if you have more debt, then you will pay more interest, and in that case, you can reduce your taxable income and reduce how much tax you pay. Yes, with those things, then maybe you can increase your net income. How do you decrease equity? How do you decrease shares? Equity is shares. Let's see whether you're gonna remember. How can a company decrease? Okay. What? Somebody said treasury stock over there. So if you remember, sorry, you said. It's echoing though, your echo goes. Okay. Treasury stock. So if I want to decrease the numbers of shares outstanding, I can buy back shares, right? And in that case, I can reduce I increase the treasury stock. And if you remember, treasury stock was negative in the balance sheet. And since it's negative, it's gonna reduce your equity. I'm not saying it's a good thing. Like when you buy back lots of shares, there will be lots of what? How am I gonna buy back those shares with? I need to pay?
Yes.
So I'm reducing cash the company has. I'm not saying whether it's a good thing or a bad thing, but it's a way of decreasing equity. Okay. So in the exam, we can ask you questions like that. How can you improve that number? Start with the basic, right? Start with increase income, decrease equity, okay? Then you can go into whatever bright idea you have. Now we are done with this part. Let's continue with, we're gonna stop at 11:30, right? I always get confused, like when it's 11:20, I'm like, oh, should we stop? No, 11:30. Okay, then we have time. Okay, now we're gonna go into other ratios. Efficiency ratios. Basically, efficiency ratios are how well you're using your assets. Remember, I'm interested in the value of the company. And one thing that's important is whether this company is using the assets efficiently. So the first one we have is asset turnover ratio, which is sales over total assets. How do you read this? This is basically sales per assets. How much sales I generate per $1 of assets I own. What kind of companies would have high asset turnover ratio? What kind of companies would generate lots of sales compared to the assets they have? take assets as fixed, and what kind of companies can produce lots of sales?
Retailers.
Retailers, yes, like, I don't know, Walmart, Real is one thing, or like clothing retailers, another thing, yes. What else? Lots of sales. Ooh, I'm not sure about service companies.
Maybe the manufacturing
Technology might be the case because they have limited assets, right? Very little assets. That might, if you have low assets, then compared to assets, you will have high number of sales. Exactly. Any type of, I don't know, fast food restaurants, for instance, right? They make lots of sales per assets they have. What kind of companies would have very low asset turnover ratio? Make small number of sales, let's say.
Maybe.
What kind of products are not sold a lot?
Luxury.
Luxury stuff, luxury hotels. I mean, you can stay in Motel 6, or where sales will be very high, or you can stay in like Ritz-Carlton. Actually, it's not that expensive in some part of the. But sorry, it's like Four Seasons, okay. So luxury items like Rolex, for instance, or Lamborghinis, for instance, like they have low asset turnover ratio, and we're going to talk about whether it's a good strategy or not later in the second round. Or utility companies, they have huge assets, big assets. Compared to that, their sales are fixed, so they will have low asset turnover ratios, for instance. Okay, so this is sales per assets. The other one is receivables turnover. How much sales you produce per $1 of account receivable. So it's all about whether you're making sales on credit or on cash, right? Account receivable was about that. So if this number is very high, let's say receivables turnover is very high, is it a good thing or a bad thing?
Bad.
Why?
Because your cash is low, you are expecting money. And in your pocket, you don't have enough money.
Be careful about that. Be careful. So it might say you're making lots of sales, which is good, or your receivables are very low, right? If this number is high. Sales are high or receivables are low. If receivables are low, is it a good thing because you're selling on cash, right? Can it be a bad thing? Having low receivables, account receivables being low?
Yes.
Yes? Yes?
Why?
Because
You didn't sell that much.
no, it's not sales, just focus on receivable. I'm just saying that the company has very low account receivable. What can you say?
Cash lose money in your pocket.
Huh?
Cash lose value in your pocket. And
Okay, this was a kind of like a tougher question to wait for, to the answer, wait from you maybe. But you can say, okay, that it's good that this company is making sales on cash, but maybe they have a very tight credit policy, right? They try to make the sales on cash, but what if its rival has very loose credit policy? In that case, you can lose your customers, right? The customers might go to this other company. So it looks good. It might be bad as well. Again, you need to make comparisons with other companies. Okay, so that's receivables turnover. Last thing about receivables, average collection period. So the name is self-explanatory. How long it takes to collect your receivables. If the number is low, it means it takes you less time to collect your receivables. It looks like a good thing, right? Or maybe again you have very tight credit policy. But in that case, this is less problematic, right? Because losing sales is related to receivables turnover, right? Collection period, it only depends on how long it takes for you to collect receivables. But it seems like having a low number is a good thing, right? Then we have the inventory turnover ratio. Inventory turnover ratio idea is the same with the assets turnover ratio. Here I have cost of goods sold over inventory. That's kind of tricky. If this number is high, what does it mean? Is it a bad thing or a good thing? It feels like it, right? Ooh, okay, now this is tricky. It's not the case actually. That's why I wanted to ask. When a sale is made, remember we are focusing on inventory this part, how well you're turning the inventory. So when a sale is made, if you remember, cost of goods sold is deducted. So actually here, cost of goods sold tells you you're making sales. So you can think it as in high sales. It's not about the cost of the inventory is increasing. No. Remember, cost of goods sold is only about written when you make the sale. You deduct the cost of goods sold, and in that case, this is directly related with sales. It's not like increased cost or decreased cost kind of thing. It's not like here. It's not the expense part, like how much you spend to buy the inventory kind of thing. Okay? So here it's a good thing actually. So if inventory turnover is high, it's a good thing. You're making more sales per inventory you have. So be careful about this little guy. The other one is average days in inventory. Again, self-explanatory. If this is a low number, it means your product sits in your stock a lower time. So you sell your inventory rather quickly. So if this number is very low, is it a good thing or a bad thing? Huh? It's a good thing. When can it be a bad thing? I cannot read lips.
When our inventory is smaller.
When my inventory is very small, and if I'm expecting a huge demand, then maybe I'm not going to be able to meet the demand. Like Christmas time, in US, people spend ridiculous amount of money to buy Christmas gifts. So before Christmas, all the inventories, toys especially, they all increase so that they can meet the demand. So you have to have sufficient inventory. But actually having low numbers of days in inventory is a good thing if you have an efficiently working inventory system. Even with like cars, I think it takes them, I think if it hasn't changed recently, Toyota's average days in inventory is like 30 days. So they don't let the car sit in the garage more than 30 days. So if your forecasts are good and if you become efficient, then it's a good thing because they occupy spaces, right? You want to produce and then sell them immediately so you can make more production. Okay, so these are efficiency ratios. I'm not going to go over the calculations this much because we did everything. So this is basically sales over average total assets. Sales come from income statement. Average total assets is the average of two numbers of total assets coming from the balance sheet. But if you have questions, let me know. Okay. It's just plugging numbers in the equation, and I already showed you how to make the calculations. Oh, I forgot to. Okay. Then we have profitability ratios. We can finish the profitability ratios and then take a break. Okay, in the profitability ratios, we have profit margin, which is net income over sales. How much income is generated per sales? Okay, the dollar amount of income compared to dollar amount of sales. If it's a high number, is that a good thing? Of course, yes, you generate more income compared to sales you have. Exactly. What kind of companies would have high profit margins? Income is a lot compared to sales they make?
The countries that have very low corporate tax, like Ireland, it's huge profit margin because corporate tax rate is like, I think 10%, 12%,
Oh,
but here
okay.
it's 20%.
What's your major? Yes. Interesting way of thinking, but I was more interested in corporations. Again, luxury products like Rolex, like compared to sale, like you generate lots of income compared to your sale, right? So the brand names, basically, like good brands, their profit margins are very high. As I said, it can be Hotel 6 versus Four Seasons. Of course, Four Seasons have high profit margin. Motel 6 has high asset margin. Right? It's quality versus quantity kind of. Okay, this doesn't give us a good picture of the profitability for investors. Instead, we use more of operating profit margin. So in that case, we're adding after-tax interest to my net income. Why am I doing this? Why am I telling you that operating profit margin gives us a better idea of profitability in terms of comparison of different firms? Actually, we talk about it at the end of the introduction slides. If you remember, I showed you two companies, one with debt, the other one without debt. And then we calculated the net incomes. The one with debt has very low income. Do you remember that? And why was the case? It's the same idea over and over again. So if you remember the income statement, so it's basically sales minus costs, minus depreciation, which is EBIT, minus interest, taxable income minus tax will give us the net income. So if I have two exactly alike companies which has same sales, the only difference is one company has debt, the other one doesn't have any debt. In that case, the one which has debt pays interest, right? Because of that, its net income will be less. But actually, having this low net income will make this company look like its profit margin is very low, right? If you compare those two companies' profit margins, the one with debt will have less net income, but they both have the same sales, right? So profit margin of the leveraged firm, the firm with debt, will look smaller. But it's not about sales. It's not about profitability. It's about the capital structure. To make a fair comparison, we say, okay, let's try to make the capital structure the same for those companies. I cannot go change the capital structure of the company, of course, but I can make the modification myself. So if I add after-tax interest to my net income for the company who has some debt, then actually it will give me a better understanding of how much income is generated for investors in general. So you're basically, this guy with that looked here, the other one looked here, but this was just because of that. So I'm adding after-tax interest, so now I can compare the numbers. I got rid of the difference, just happened because of the capital structure. Then I can make the comparison. So operating profit margin is a better profitability measure because now I can compare companies with different capital structures. It gives me a better, fair comparison. So if I'm asked to calculate loss operating profit margin, what am I going to do? Again, I need net income coming from the income statement. After tax interest, I already calculated before, 181, which was here. Interest was 287. I calculated the tax and everything. here. So we did this before. And then the last one was sales. Sales comes from the income statement. And I'm done. Oh, one thing. Sometimes in the exam, not about this. Do you have any questions about this? Sometimes here, for instance, for return on assets, I said, oh, you can use average total assets or total assets at the beginning of the year. Sometimes you ask me, Hocam, which one should we use? I mean, if we are giving you 2 years, you can use the average. If you have only 1 year, you can't. I mean, so don't worry. I mean, both of them are fine. We don't ask tricks. Everything is fair. Don't spend time on details, basically. Okay, let's take a break for 10 minutes and we'll continue.